everyone, today the internet is flooded with hundreds of thousands of videos on which stocks to buy, but you will hardly find any good video on when to sell a stock. And I also get a lot of requests to discuss what is the right strategy for selling a stock. Well, honestly speaking, there is no perfect strategy for selling. I'll give you an example. So let's say there's a stock, let's call it stock A, and there are two types of investors. They both invest in the company at let's say 200 rupee. Now after first year, let's say the stock generates 50% return. So first investor booked the profit by selling the stock, but second investor continued to hold it further. Now can you say that the first investor did the right thing by exit? No, you can't. Because it can happen that 5 years down the line that stocks generate 200% return. In that case, you would say that the first investor should not have sold it. But what if the stock falls after generating 50% return? In that case, you would say that the first investor was right. So in the hindsight, it's very easy to look at past record and say you should have exited the stock. But the fact is that right now, if you have to take a call on exit, it's a very difficult call. Here, please note that we are only talking from an investment point of view, not trading. In fact, I've closely observed the investment style of many ace investors and found that while sometimes they do time their exits at good levels, there have been cases where the stock jumped a lot after their exit, or they held on to the stock and it fell down. For instance, I closely follow Mr. Ashish Kacholia investment, and there are many examples where he exited quite early and then stock zoomed even after his exit. Gravita India is one example where shareholding pattern is not showing his name since last 2 quarters. So it looks like he sold his stake in the June quarter. From those levels, stock has zoomed a lot. Then there's a stock brand concept that has corrected more than 50% from top, but he's still holding stake. So the point is, there's no perfect strategy to exit. Having said this, there's a framework that you can follow which would give you a better idea in terms of when to exit and help you optimize your returns. I've studied many articles, books, and watched videos of many financial experts to understand their thought process on exit. And in today's video, I'd like to share this knowledge with you all. So we'll first discuss the common mistake people make while selling a stock, and then we'll look at the framework to sell the stock. Alright, let's get started. The biggest mistake many retail investors make is they sell stock the moment they see some profit on the table. If your selling decision is purely on the basis of stock price movement, let's say if a stock has generated 40-50% return, then it's a mistake. The only reason for this mistake is no understanding of fundamentals. It reminds me of the quote from Mr. Peter Lynch. He says that selling your winners and holding your losers is like cutting the flowers and watering the weeds. What he means is, if you sell your winners too early, only on the basis of stock price movement, you would lose out on wonderful compounding opportunity. At the same time, he also says that you should not hold your losers. But it does not mean that if a stock has fallen 20-30% or if the stock has not generated any return for 1 year, then you sell it. Your buy and sell decision should not be on the basis of stock price movement. Remember that. It has to be on the basis of fundamentals and valuation. A fundamentally strong company can generate 500% return, but still the valuation could be reasonable and there could be a lot more upside in the future. At the same time, if a fundamentally strong company's share price falls 20-30% due to some temporary reason, it could actually be a buying opportunity. While talking about the loser, Mr. Peter Lynch is talking about selling fundamentally weak companies and not holding them or accumulating them. But you need a fair understanding to differentiate whether the company is fundamentally strong or not. And that takes a good few years of knowledge and experience in the stock market. Also, some people try to time the market. So when the fundamentally strong stock is falling, they think that let me sell that stock today and I'll buy it at a lower price. The problem with this approach is when you sell and the stock falls by let's say another 10%, you'd wait for further 10% correction. If there is another 10% correction, you won't have the courage to buy it. And eventually when the stock price recovers, you would regret it. You might time the buy and sell once in a while, but it is not sustainable. So the key to create good return is to hold your fundamentally strong companies even during difficult times. And never sell your stocks only on the basis of its price movement. I hope it makes sense. Now let us look at the framework to sell this stock. So the first step is to create an Excel sheet of all the stocks in your portfolio and bifurcate your stocks into 2 buckets. Core portfolio and satellite portfolio. Core portfolio would include stocks that you want to hold for long term irrespective of market cycle. Whereas satellite portfolio would include stocks that are in upcycle. You need to churn this satellite portfolio more frequently where you exit when the upcycle is about to end and invest in stocks where upcycle has started recently. Obviously, it's much easier said than done, but I'll give you a few examples. So in my case, my core portfolio includes stocks from sectors like IT, banking, pharma, auto, and consumption related sector like FMCG, consumer durable, that have been a huge wealth creator in the past and would continue to create wealth in the future. Here please note that these sectors also grow through cycle. For instance, banking sector today is in weak shape, but then it's part of my core portfolio, so I have not sold any banking and financial sector stock. Auto sector is currently looking weak, temporary, but I'm not selling it. In fact, I look at this downturn as an opportunity to accumulate more of these core portfolio stocks. And there is one more sector which is now part of my core portfolio, and that is recycling. It's across your metal recycling, water recycling, plastic and waste recycling. And my satellite portfolio includes stocks that are currently in upcycle. For instance, defense and railway were in massive upcycle a few months ago. Today, solar is one sector that is in massive upcycle. Power transmission space is in massive upcycle. Hotel and real estate have witnessed a huge upcycle since COVID and are still looking strong. Then data center is one theme that is really hot today. So the goal is to keep churning the satellite portfolio and benefit from the upcycle. Having said this, please note that being a long-term investor, majority of my investment is in core portfolio. You need to decide how much allocation you want in core portfolio and how much in satellite. Once you do this exercise, it would make your selling decision much easier. Now let's first discuss the framework for selling the satellite portfolio. So the most important rule of selling a satellite portfolio is when the valuations go much ahead of fundamentals. So what happens is when there's an upcycle in a particular sector, everyone wants a pie in that space and everyone rushes to buy the top stocks in that sector. So initially when the sector or theme is unexplored or not that popular, if you make an entry, it can create great wealth. But once that theme or sector becomes very popular, the valuations become crazy high. Let me give you a few examples. During COVID, chemical sector stocks zoomed exponentially. Initially, they were undervalued when the chemical theme was undiscovered. But slowly when everyone started talking about it, the valuations became expensive and then there was a point when earning growth started slowing down. So those who entered during the early phase of upcycle and exited made a hell lot of money. But the fact is, majority of retail investors enter into a particular sector or theme when it is already hyped. I know a lot of people entered into chemical sector near the peak and faced losses. Likewise, today defense and railway stocks are down big time after massive wealth creation. Then solar stocks, power stocks, data center stocks today are in big upcycle. But my problem is majority of these themes are already in hype and it's probably not a great time to buy those stocks now. Because I don't see a lot of valuation comfort. Someone who entered at lower levels would make money. For instance, I remember discussing NetWeb as a part of data center theme quite early and has created a good wealth. But can you enter now? I'm not sure. Can you exit NetWeb? Well, valuations are certainly very high. But it is also a fact that NetWeb is consistently growing exponentially. Earlier this growth was on lower base, but you can't expect NetWeb earning to double every year. So there will be a point when earning growth would slow down and then investors would book profit. In my opinion, it's a good time to consider booking some profit in NetWeb. Likewise, the electronic sector we identified very early and created a lot of wealth. Today the valuations are very high, but earnings are also growing rapidly. So here you need to closely track the quarter results of stocks that are in upcycle. And the moment you realize that valuations are too high and the growth is slowing down, you can exit. Here you also need to keep a close eye on order book growth. A lot of power sector, solar sector stocks are growing at a fast rate. But the market does not care about past growth. Market keeps a close eye on the order book because strong order book reflect growth in the future. If the order book slows down and valuations are too high, it's time to exit. So that's the strategy on satellite portfolio. Let me again clarify that while it sounds very easy, it's extremely difficult to time the entry and exit. Especially for a person with a job or business who does not get enough time for research. A lot of retail investors end up buying stocks from themes and sectors that are near the peak and end up losing money because they simply look at the past return. Personally, I keep a close eye on more than 200 quarter results and based on that, I take a call on what to do. This is part of my exclusive community where I share one exclusive video every week, including my own investment strategy. You can explore it on my website or via the join button. Now you might ask, Sahil, how do you identify the sectors or themes that are in upcycle or have recently started the upcycle? For that, you need to keep your ears and eyes open to identify those next sectors and themes that are in early stage of upcycle. For instance, during COVID, travel and tourism got impacted very badly. So hotel and airline stocks tanked badly, but when the economy opened up, there was a massive demand for travel and it resulted in huge profits for hotel and airline stocks. That was a great time to invest in that sector. At the moment, I don't see any sector that is undervalued or undiscovered as we have already seen a massive bull rally. The sectors that are showing high growth like electronics, solar, capital goods, data center, they're all trading at expensive valuation in spite of this correction that we have seen in the past. As long as they continue their earning growth, their price might continue to go up, but the moment things go negative, these stocks would nosedive. And recent example is railway and defense. By the time people would realize, many stocks from these sectors are down 40-50%. It is not that railway and defense won't grow, but valuations were crazy high and hence they witnessed profit booking. So the conclusion is, in a satellite portfolio, you need to identify themes and sectors at an early stage when they are not well discovered and valuations are reasonable. And there's a strong earning growth potential. And exit when there's a lot of hype, valuations become too expensive and earning growth starts slowing down. Now let us discuss the strategy to exit in the core portfolio stocks. When it comes to core portfolio, the stocks are for long term. So you don't buy and sell stocks frequently from your core portfolio. Having said this, the first rule is same for core portfolio, where if the valuation goes way above the historical valuation, you can sell it. For instance, Tata Elxsi witnessed 10 times growth during COVID period. At the peak, valuations were crazy high at PE of more than 100, and then it witnessed a long period of correction and consolidation. Likewise, Avenue Supermart was growing at a fast rate and commanded a very high valuation. It's been more than 3 years and stock is still down more than 30% from those October 21 high. Another example is Bajaj Finance, where its price to book was at levels of 12 in 2021. Since then, the stock is down more than 10%. Price to book has now fallen to all-time lows of below 5. For me, price to book of anything above 7 to 8 was expensive for Bajaj Finance. It was time to exit. And today at price to book of around 5, it's time to invest. Please note that these are all examples of fundamentally strong companies. But at one point in time, due to hype, the valuations went crazy high. So here you need to decide what is the high valuation and what is fair valuation. Again, there's no fixed formula. It requires a good levels of experience in the market to understand what is expensive, what is fair and what is cheap. And there are various factors that determine valuation. We have discussed these PE multiple and PEG multiple in detail in our previous discussion. For instance, Nestle always command a high PE ratio. You can't compare it with TCS at PE of 30 and say that TCS is cheap and Nestle is expensive. You can look at the historical median valuation for well-established players. For example, Nestle 5 years median PE is 80 against its current PE of around 70. So that is a fair valuation. There can also be a case where earning growth is slowing down for the company and there are no signs of recovery in the near future. That can also be a reason to exit. Apart from valuation, second reason to sell a company is when its moat gets breached or the business quality is deteriorating or top management is leaving the company or management is constantly failing to meet their guidance or there are unethical business practices. Here please note that a specific sector or business may face certain external challenges that could impact their performance. For example, IT sector today is facing issue with slowdown in growth in US economy, which is not looking in great shape. But that is a temporary situation. Likewise, recently the FMCG sector has fallen due to slowdown in growth, but that is due to temporary external reason that has impacted the entire sector. In fact, such situation creates buying opportunity rather than selling, provided you get a fair understanding of what is temporary problem and how long can it last. Then third reason to sell a stock is when you find a better investment opportunity and you don't have enough cash. Then you can sell a few stocks from your portfolio where the growth opportunity is limited to buy the new opportunity. But please don't take this decision only on the basis of 1 or 2 good quarters. This is one common mistake where retail investors get carried away when a company posts 1 or 2 great results. The key question here before investing is how sustainable is the growth. Fourth reason to sell a stock from the core portfolio is when you need money to fulfill your financial goals. Obviously, the entire idea behind investment is to achieve financial goals. So if you are near your financial goals and need money, you can book profit. Fifth reason to sell a stock is when you have too many stocks in your portfolio and it's getting difficult for you to track them. Then you need to consolidate your portfolio by selling a few stocks from the list. So if I quickly summarize, there are 5 reasons to exit from stocks in your core portfolio. First is when the valuations are way too ahead of earnings or if the earning growth is slowing down and there are no signs of recovery in near term. Second is when there are company specific issues like deteriorating business quality, breach of moat, top management exit, management consistently failing to meet the guidance and so on. Third, if you find a better investment opportunity. Fourth is when you need money for financial goal. Fifth is when you have too many stocks in the portfolio and you are not able to track them. So in this video, we discussed the strategy around selling the stock. Initially, we discussed in which case you should not sell the stock. And then we discussed the framework around selling the stock across your core and satellite portfolio. Now tell me in the comment, when do you consider selling stock from your portfolio? If you find this video useful, do share it within your circle. I'll see you in the next video. Till then, take care.